An income statement is a crucial financial document that businesses use to assess their financial performance over a specific period, typically a year. It provides a detailed overview of the revenue generated by the business and the expenses incurred, ultimately revealing the profit or loss made during that time. The income statement is divided into three main sections: the trading account, the profit and loss account, and the appropriation account. Together, these sections offer a comprehensive picture of how well a business has performed and how its profits are allocated. The trading account is the first part of the income statement and focuses on the business's core trading activities. It records the revenue generated from sales and the direct costs associated with producing or purchasing the goods sold, referred to as the cost of goods sold, COGS. For example, a clothing retailer's trading account would list the total sales revenue from selling clothes, along with the costs of purchasing stock. The difference between sales revenue and the cost of goods sold is known as gross profit. Gross profit is an important figure because it reflects how efficiently a business is managing its production or purchasing processes. If a business's gross profit is low, it may be a sign that the cost of producing or buying its goods is too high compared to its sales. Once gross profit is calculated, the income statement moves on to the profit and loss account, which considers all the other operating expenses that a business incurs. These include overhead costs such as rent, wages, utilities, and marketing expenses. For instance, the clothing retailer would record the salaries of its staff, the cost of renting its shop, and the money spent on advertising. By subtracting these operating expenses from gross profit, the business arrives at its operating profit, also known as net profit before tax. This figure represents the profit generated from the business's normal activities, before any interest payments or taxes are taken into account. Operating profit is a key measure of a business's overall performance, as it shows how well the company is managing both its sales and its operating costs. The final part of the income statement is the appropriation account, which details how the business's profits are distributed. This section shows the tax paid on the business's profits, any interest paid on loans, and the dividends paid to shareholders. After all these deductions, the remaining profit is known as retained profit, which is reinvested back into the business. For example, if the clothing retailer has paid its corporation tax, settled any loan interest, and distributed dividends to shareholders, the leftover profit is retained for future growth, such as opening new stores or investing in new product lines. Retained profit is an important source of finance for businesses, as it allows them to fund expansion or improvements without relying on external borrowing. The values presented in the income statement give a clear indication of a business's performance over the period. By examining the revenue, costs, and profits, stakeholders can gain insights into how efficiently the business is being run. For example, a sharp increase in operating expenses without a corresponding rise in sales revenue may indicate that the business is becoming less efficient. Conversely, a growing gross profit suggests that the company is either increasing its sales or managing its production costs more effectively. Investors, creditors, and managers use these values to assess the company's financial health and make informed decisions about its future direction. Comparing income statements from different years provides valuable insights into a business's growth and development over time. A business might see an increase in gross profit one year due to higher sales, but if operating expenses rise sharply the following year, the net profit could decline, indicating potential inefficiencies in cost management. For instance, if the clothing retailer's sales have grown steadily over the past few years but its profit margins have narrowed due to rising overheads, this could be a warning sign that the business needs to reduce its expenses or find ways to improve efficiency. By analyzing trends in income statements, businesses can identify areas where they need to cut costs or increase revenue. Year-on-year comparisons also allow businesses to evaluate the impact of external factors, such as economic conditions or changes in market demand. For example, a business might notice that its revenue fell during a recession, but its careful cost management helped it maintain profitability. Alternatively, if a business expanded into new markets, comparing income statements could reveal how successful that expansion was in terms of generating additional revenue and profit. In conclusion, an income statement is an essential tool for measuring a business's financial performance. It is composed of three parts: the trading account, which calculates gross profit from core activities, the profit and loss account, which factors in operating expenses to determine net profit before tax, and the appropriation account, which shows how profits are distributed. The values on the income statement provide a clear picture of how well the business is performing, and comparing income statements from different years helps businesses track their progress and identify areas for improvement.